Buying residential real estate in British Columbia demands exact math. Before you calculate your long-term return on investment, you must survive closing day. Let's look at a standard transaction with a baseline purchase price of $900,000. A common starting point for a buyer is a 10% down payment, requiring exactly $90,000. It is easy to assume that this single lump sum is the only cash you need to bring to the table to acquire the property. In reality, the true liquid cash required to close this specific deal is closer to $115,000. A $25,000 gap between your statutory down payment and your actual cash requirement can easily derail a transaction if discovered at the last minute. Breaking down the actual costs line by line is the only way to avoid a closing day liquidity trap. The first point of confusion usually lies in the difference between the earnest money deposit and the final down payment. These are legally distinct elements that occur at completely different stages of the timeline. The deposit is an initial payment required within a few days of an accepted offer. It serves to make the purchase contract legally binding, and the funds are held securely in a real estate brokerage trust account. This upfront money is not an additional fee. It directly forms the very first portion of your total down payment amount. You are simply paying a fraction of your required equity early. If that total down payment remains under 20% of the purchase price, you trigger the requirement for mortgage default insurance. This mandatory policy exists strictly to protect the lender in the event that you default on your mortgage. It offers no financial protection to the buyer. Depending on your specific loan-to-value ratio, the premium rates for this insurance currently range from 2.80% to 4.00% of your total loan. This balance sheet shows exactly how that premium is paid. Rather than upfront cash, the cost rolls directly into your mortgage principal. Because it's capitalized, it increases your total debt, and you will pay interest on it over the entire amortization schedule. Your initial deposit locks up your liquid cash today, while default insurance leverages your future equity. Together, they form the mechanical baseline of your purchase structure. Next, we hit the single largest non-negotiable cash requirement in the transaction, the British Columbia Property Transfer Tax, or PTT. The province calculates this tax as 1% on the first $200,000 of the property's value and 2% on the remaining value up to $2 million. Looking at this tiered bar chart, we can see how the first-time homebuyer exemption alters the math. For qualifying properties, the province provides a tax-free zone on the first $500,000. However, our $900,000 target home exceeds the $835,000 full exemption limit and the $860,000 partial limit, exposing our buyer to the full upfront PTT bill. Once the taxes are accounted for, you must hire a legal professional, either a lawyer or a notary public, to officially transfer the property title into your name and register the mortgage. The base fee for a professional to prepare the documents and review your contract typically ranges between $1,500 and $2,500, but your final legal bill will also include mandatory disbursements. Your conveyancer must collect a $300 to $600 premium for title insurance, alongside statutory registration fees payable directly to the Land Title and Survey Authority. Unlike your mortgage insurance premium, these taxes and legal disbursements cannot be added to your loan. They represent a hard cash wall that must be cleared to take legal ownership. The cash requirements begin well before closing day. During the subject removal period, you must finance the physical and financial due diligence of the asset. A professional home inspection runs between $500 and $700. If you are purchasing in an established neighborhood with older character properties, you will need extra cash for specialist reports, like a lateral sewer scope or an underground oil tank scan. Financially, an A lender will strictly require an independent appraisal to verify the asset's fair market value. This adds another $400 to $600 to your upfront costs. Fast forward to closing day. Your notary will present you with a final statement of adjustments, which includes a section for operational adjustments. Because property expenses are prorated, you reimburse the seller in cash for municipal property taxes, water bills, or strata fees prepaid past your possession date. To handle this, a dedicated post-possession buffer accounting for 1 to 2% of the total purchase price is necessary. This buffer ensures you can absorb local moving company rates, which run between $1,500 and $3,500, cover your utility hookups, and pay your mandatory first-year home insurance premium. Stripping your liquidity to exactly zero to afford the down payment leaves you exposed to immediate operational liabilities. Due diligence and a day-one cash buffer ensure the property is a secure asset, not an immediate crisis. Returning to our $900,000 British Columbia property, the final picture is clear. The assumption that a minimum 10% down payment requires only $90,000 falls short. When we factor in the taxes, the legal disbursements, the due diligence, and a responsible operational buffer, the realistic cash requirement lands at $115,000. Identifying this discrepancy weeks before closing ensures your capital is ready before the final deadline, removing the volatility from the final days of the deal. Before you ever sit down with a mortgage lender, you need to define your own specific baseline budget. You can run your exact numbers using the free BC Closing Cost Calculator linked in the description, or by visiting silentstory.ca. When acquiring property in British Columbia, accurate data provides the only reliable safeguard for your liquidity.